And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story, real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
Hey, good morning. I dropped my pen. Hey, good morning. Welcome to the show. Of course, it is Wednesday. It's the Hump Day edition of the Real Investment Show. Brent Clanton dressed up very nice today. So you're just trying to dress to impress today? Is that the goal?
Yeah. Yeah, that'll work. That and my jeans were dirty.
There you go. So today, of course, Danny Ratliff joining me as well, and we'll talk about a few things. One thing is interesting going on. Yesterday, I did a review video with Adam Taggart, and one of the questions that keeps coming up is about gold, right? So everybody wants to know, I got to buy gold. The end of the world is coming. Got to own gold. Okay, a few things about gold that you need to understand. First of all, gold has now had the worst streak of losses since 1869, right? So, you've got to go back a long way to find a period in time where gold has performed this poorly over a period of time. Now, this of course, completely flies in the face of everything that investors have been told about gold for the last few years, which is inflation's coming, you've got to own gold as an inflation hedge, etc. And that's kind of a long-standing case. However, if you go back in time, really gold has not performed as a good inflation hedge, period, ever. There are moments in time where gold performs exceptionally well. In fact, if we just go back to really, kind of 2021 in general, gold was performing fairly well. So again, and we didn't have a lot of inflation back in 2021, right? That's just where we were just starting to kind of get the initial bouts of inflation. So gold was performing well. What drives gold is real interest rates, and that's the thing you really want to keep a watch on. So if you're a gold investor, want to own gold, that's great. Watch for a reversal in real rates. Now, what is real rates? Real rates are inflation subtracted out of your interest rate. So when interest rates when inflation comes down and interest rates start to fall, real rates will reverse. That's when gold will perform better. And so that's when you want to start owning gold. Gold is not a replacement for a currency. We don't trade that anywhere in the world. You can't go to Starbucks and trade in your gold coin. Well, you probably could if somebody was smart enough at Starbucks to figure that out, but you can't convert gold into an actual barterable, asset right now, right? But that's just not the way we work. The entire world is a fiat currency. So if you want to do anything or transact any business with gold, you've got to convert it back into dollars. Now, if you happen to be a foreign investor, gold's actually doing very well for you because why? Gold trades in dollars everywhere in the world. So because of the strength of the US dollar, gold is performing well if you happen to live and operate in a foreign currency. Unfortunately for US investors, we don't get that luxury because we buy and sell everything in dollars. So the strong dollar is also weighing on gold as well. So again, the point here is look, if you want to own gold and those type of things, that's completely up to you. But as an investment, this is one of the things that we often talk about on the show is that when we're investing capital, we need to invest capital in areas that are working. And right now, this has just been an area that just hasn't worked well. And again, it doesn't mean that it'll never work well again, and it doesn't mean you should never own gold. There will definitely be a period in time you want to own gold. But again, one of the questions was yesterday. It's like I'm just buying. I'm just putting everything into gold right now because the world's coming to an end and inflation's high and all these type of things. So that's great. It's just not working. And the point here is that, betting on, and this is one of the points I made yesterday, which is we can all worry about the end of the world and being in a bunker and those type of things, but that's not really a great way to live, right? Being uber pessimistic all the time, it's not really a fun way to live your life. Having some optimism, some hope that things are going to get better, typically works out better, especially in the investing forum over time, because again, things do get better, right? Right now, we're going through an earnings slowdown. We're going through a potential recession next year. Got a lot of concerns, right? So you can kind of certainly understand the allure of gold in an environment where things look so bad. But typically, what happens historically is that things never work out as badly as we think. Something happens in life and we say, oh, this is the worst thing ever. This is just going to be a terrible thing. Nothing's ever going to be the same again. But things get better, right? Things are never quite as bad as we think they are. Things do get better. Things do turn around. Warren Buffett once said, never bet against the American. And that's right. Never, the idea that things are terrible and are never going to return to normal, that's typically a bet that doesn't work out. So again, as we start, thinking about moving into next year, and this is going to be one of the things that we talk about on November the 15th. We have our Learn to Learn coming up on November 15th, our end of the year kind of review of the markets. But one thing we'll be talking about moving into next year is the recession that we're going to potentially have. But see, everybody knows the recession is coming, right? That's already getting priced into the financial markets, into earnings, into expectations. All that's getting priced in. So if the recession that comes isn't as bad as expected, or even if it is bad as expected, a lot of that's already getting priced into stock prices, into earnings expectations, into growth rates. Now, we haven't done enough yet, right? We're going to have more of that to go. So don't think that we're already at the bottom, because we're not. But the point is that as we go through this cycle, you have to remember that markets are already pricing in a lot of these things. And so by the time, this is why when you look back in history, the market always tends to lead, the market tends to bottom before, you get to the recessionary bottom or whatever it is, because the market's already anticipating the recovery. So again, as an investor, what's our job? Our job as an investor is to invest capital where we have an opportunity to make money. And we also want to invest capital in the areas that we expect to make the most money, right? So again, as we start thinking about where the economy is, where we are now, as we go into the fourth quarter, look, it's going to be a fairly weak fourth quarter, economically speaking. First and second quarter next year, probably weaker as we go through this, because all these rate hikes that the Fed's doing now, that's going to show up next year. So we're going to have slower economic growth. So we need to be cautious about our investing for the time being. But again, don't mistake where the future growth is going to be. Again, being in the bunker is one thing, and again, having a lot of beanie weenies and ammo and those type of things, awesome, nothing wrong with that. But when it comes to managing money, just remember that things don't always work out as anticipated. And that doesn't mean that it won't ever work out that way, but it does mean that we need to pay attention to where kind of things are going. So that's just kind of a quick rundown on where we are. Now, this afternoon is the FOMC meeting. We'll talk about that after the break a little bit with Danny Ratliff. Of course, the expectation is for a 75 basis point rate hike. Once that occurs, that's pretty much baked into the markets as well. Markets kind of trading a little bit sloppy yesterday and this morning, kind of ahead of that Fed meeting. What's important is what the Fed's going to say at their press conference this afternoon, and we'll talk about that right after the break here with Danny Ratliff, and talk about potentially how the market reacts to this. And an article I'm writing for Friday is why the FAANG stocks aren't necessarily dead. So this is all going to kind of play in together, and we'll talk about this right after the break. Be sure you're by the website, though. Get registered for the upcoming event. It's November the 15th at noon? Yes. At noon. It's via Zoom. So we'll be on Zoom, me, Danny, Richard, and we'll be talking about the year-end economic review. So make sure you're signed up there. It's absolutely free. We'll spend about an hour just kind of talking about markets, money, what the outlook is, what happens post-midterm elections, because that's next week as well. We'll talk about all that after the break right here with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realininvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realininvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realininvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realininvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realininvestmentadvice.com/retirement, realininvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. Get started right now at the website, realininvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realininvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realininvestmentadvice.com.
The Real Investment Show.
Talk about that. And welcome back to the show this morning. It is, of course, Wednesday, it's hump day, and that means that Danny Ratliff's in the house. Danny, what's up, man?
Hello, hello. How are you?
Good. So, a few things. Brent pulled I did a tweet yesterday on where Americans get the majority of their news, which is off of social media. Brent pulled that graphic this morning, put it on my note page. It's pretty funny. I mean, the 31% of Americans get their misinformation on Facebook. Information, I should say.
Freudian slip.
Yeah, information on Facebook. YouTube's number 2, Twitter number 3, followed by Instagram, TikTok, Reddit, Snapchat, and LinkedIn. But of course,
it's kind of scary.
Yeah. But everything on the internet is true, as they say.
I don't even know what to believe half the
garbage out. And you wonder why. Yeah. And that was my tweet yesterday, which is, and you wonder why, ... Anyway. So a couple of things I just wrapped up with in the last segment. This afternoon is the FOMC meeting. Jerome Powell and crew will be hiking interest rates by 75 basis points. That's what is widely expected. I don't expect any deviation from that. What everybody is anticipating. So where do things go haywire this afternoon, one way or the other? This afternoon, what is expected is that they'll hike 75 basis points and start talking about slowing the pace of rate hikes and setting up the basis for a 50 basis point hike in December. That's what's expected. If the Fed comes out and says, we're nowhere near slowing down the pace of rate hikes and we've got to be more aggressive, whatever it is, if they allude to a more hawkish side of the ledger, stocks can get hit pretty hard today. If they come out and kind of come in line with expectations, markets will probably be a little flat to up. Kind of this idea that they're going to start slowing rate hikes is the kind of the quote unquote pivot, but a lot of that's already kind of priced into stocks here over the last couple of weeks. Markets have had a nice rebound here. So a lot of that kind of, if they stay kind of party line right now, wouldn't expect markets to do a whole lot. If they come out and say something like, we're reevaluating our inflation concerns, something more dovish, then stocks could be up sharply this afternoon. So again, that's kind of your outcomes. Don't really expect them to deviate too much from what's already kind of been laid out there. I mean, it's despite the fact that speakers have been in blackout for the last couple of weeks going into this meeting today, it's been pretty widely discussed throughout Wall Street and economist reports and media and everything else, kind of what the expectations are, which again is the 75 basis point rate hike, and then an allusion to slowing down the pace of those rate hikes in December, and then the first 2 meetings of next year, which are 25 basis points apiece, the terminal rate being 5%. So if the Fed kind of lays that out, that's kind of what's already widely expected. Stocks may not do a whole lot this afternoon. So we'll just see how things kind of work out. Danny?
Now, what do you expect that to do to the yield curve? If obviously, if they back off, they can become a little bit more dovish. Most of this has to be priced in, right?
You would think so, but the yield curve is already pretty much laid out. And again, what's interesting is despite the fact that the Fed's been hiking rates, yields really haven't gone much of anywhere.
No, they've actually come down a little bit from their highs.
Yeah, and so even though the Fed terminal rate is 5%, the 10-year Treasury rate's still hovering right around 4%. So what the 10-year Treasury rate and the yield curve is already telling you is that a recession's coming. Right, so that's one thing we already know, and you've got you've got more than 60% of the yield. We track 10 different yield spreads between treasuries. 10-month versus 10-year versus 3-month, and 10-year versus 5 years, and et cetera, so forth, and 10-year and 2-year and all that. So we track the most economically sensitive ones, and we have 10 of those that we track, and 60% of those are now inverted. Just now, historically, when you get above 50% inversion, right? So when you have 50% of those 10 yield curves inverted, you have always, without exception, had a recession, within the coming year. So again, at 60%, the odds are, flat on that we're going to have a recession. I think that the Fed understands that risk, and they also understand that when you have a recession, inflation comes down. And you've also got to imagine that they already understand too as well. You're already seeing housing prices come down. You're already seeing a big slowdown. That hasn't fed into inflation yet. Auto prices are coming down. That hasn't fed into inflation yet. So you have to think that the Fed is already aware that we've probably seen peak inflation. So for them to pull their foot off the gas here a little bit would make a lot of sense.
Yeah, that does make sense. So, you mentioned gold earlier. Everybody's been talking about gold. I mean,
Right.
we get calls on that daily. Obviously hasn't worked. But if they do make this shift, if we see them, if they're successful actually, bringing the dollar down a tad bit, does that when gold starts to work?
Yeah, because what makes gold work is real interest rates, or I should say, what makes gold work or not work is real interest rates. So as I said, you take the interest rate, subtract out inflation, that's real rates. So when you start to see real rates reverse, that's when gold's going to start performing better, because that's where you're heading into a recession. That's where you get disinflation, and that's where gold's going to, typically an environment where gold's going to start to perform better. So, there's a real possibility here that over the next year, gold will start to perform better. And again, it's like bonds, right? Bonds have had the worst drawdown this year since 1789. You've had the worst drawdown in gold since 1869 in terms of months of negative performance, right? So, whenever you have, those type of environments, and again, this is what I was talking about earlier, is, kind of betting on the end of the world stuff never really works out that well because things tend to change. But you're starting to get drawdowns in your 60-40 allocations that you haven't seen since the late 1700s. Those things don't last very long. And historically, when you go back and look at history, when you have these big drawdowns or big bear markets in these asset classes, they tend to perform a lot better. Back in 2020, we were talking about nobody wanted to own energy. Now you can't get people to sell energy stocks, right? Because they're performing so well. That's going to end as well. So you're going to see a rotation out of energy stocks, and you're going to see it go into beaten up technology stocks. You're going to see money go back into bonds and go back into gold, because those asset classes will start to perform better as you start to see disinflation in the economy and those type of things. So again, you just have to look ahead and say, okay, this is what's happened, but what's coming next? What our inclination is as investors is that we tend to think that whatever's happening is now the new permanent trend, and that's never going to reverse.
Well, we look backwards, right? It's like the old school Morningstar reports where everybody looks and says, oh, this has been so good. It was great last year. Just like the Ibbotson charts, the quilt.
Yeah.
We look in each year, the top's usually going to be towards the bottom. And that's not every year, but usually that trend dies and the bottom goes towards the top. And, it's just picking the right ones.
Yeah, no, exactly. But again, it's always to think about where, again, it's the old Wayne Gretzky, saying, skate where the puck's going to be.
Yep, not where it is.
Yeah, but the problem is, as investors, what we tend to do is we tend to focus on where the puck is.
Well, we usually skate to where it was is the problem.
Or skate to where it was. Yeah, that's actually probably a better analogy. But that's what we do as investors. But that's the hard part, right?
Yeah.
The hard part is buying stuff that nobody wants, right? Because it's not working. Buying, and I'm writing an article for Friday talking about no, FAANG stocks aren't dead. And the reason I'm writing that article is because everybody's starting to write articles that FAANG stocks are dead. You got to go buy other companies. I wouldn't recommend putting all your portfolio into FAANG stocks, and I wouldn't recommend putting all of them into all the FAANG stocks, right? There are some that are going to perform better than others. But when you start seeing articles and headlines saying that something is dead, it's generally the time you want to start taking a look at those assets classes. And I laid out 3 reasons, in this article for why that's the case, which is stock buybacks. These mega cap companies, Boeing, GE, Apple, Microsoft, et cetera, they have the capital to buy back shares. So share buybacks is one. Passive investing is a big one. 31 cents of every dollar goes into the top 10 stocks of the index. And then lastly, is just that those have the potential in a disinflationary environment to have the largest rates of earnings growth. So, and most stable. And that's what our investors are going to look for when we get into a recession next year. So again,
yields start dropping again.
Exactly. So got to think about where the puck's going to be next year. So anyway.
Yeah, a lot of moving parts right now.
It's been an interesting year. Glad it's almost over. So yeah, November the 15th, as I said, we're gonna discuss this a whole lot more on November the 15th. So go by the website and get registered for that webinar. Seats are filling up fast. There's no limit, but they are filling up. So because it's all online. So it's gonna be November 15th, and at 12 noon, bring your own lunch, and we'll go through the economy. We'll go through markets. We'll talk about next year, what it all kind of looks like. And of course, this will be post midterm election. So once we get through kind of the midterm elections, we'll also kind of know where we are in terms of, who's going to control House and Senate. We know who controls the White House. That'll stay the same. But gridlock, what does that mean for the economy, and how do markets typically perform post midterms? And what are the outcomes looking like that as we move into next year?
Yeah, it will be answering your questions. So go to realinvestmentadvice.com, go to ask a question. We'd love to get as much of those answered as we can. So go ahead and get those down, because we are going to have a limited amount of time. Fortunately or unfortunately, we could probably spend several hours doing it.
Yeah.
But I know a lot of you guys have very similar questions. We'd love to get to those as well.
Yeah, and so we'll try to lump all those together and get them answered. So, but as I said, so this afternoon, kind of the big thing will be the FOMC meeting. That'll be out at 2:00 this afternoon. Again, the announcement is not really what's going to move markets, right? What's going to really move markets is the presser that Jerome Powell gives immediately afterwards. So that's when he gets in front of all the reporters and he starts answering questions. And that's where things either tend to go haywire or tend to do really well, depending on what he says. Because again, it won't be what he says. It's going to be how the markets parse out what he says. He can say, we're not hike. We're going to keep hiking rates, and the market's going to hear that as, oh, that means you're going to pause, and then stocks can take off running. So
But if he pivoted today, that wouldn't necessarily be a great thing either.
It's you don't know. This is the whole problem, right? Anyway, be right back after the break.
Investment Advice blog. It's required reading for the informed investor. Catch it today at reluctance.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
You have to scratch your head and wonder why Nancy Pelosi on Face the Nation had this to say about inflation.
The fight is not about inflation. It's about the cost of living.
Those are the same thing, Nancy.
The Real Investment Show podcast. Same show, your schedule.
The next iteration of this will be, it's not unemployment that's the problem. It's just that you don't have a job.
At realinvestmentadvice.com.
Anyone can sell you insurance, and they'll gladly take your premium dollars. The RIA Insurance Agency can provide you with insurance solutions tailor-made for your needs and lifestyle. Because everyone's assets are different, let RIA Insurance review what you need to protect and how. We won't sell you insurance, but what you need will be a matter of policy. RIA Insurance Agency. 888-915-0780. 888-915-0780. RealInvestmentAdvice.com. Click on the insurance tab.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. What will the midterm elections mean for markets? Register now at realinvestmentadvice.com. Realinvestmentadvice.com.
You're listening to The Real Investment Show.
So yesterday we talked a little bit about Facebook, Meta, and the idea of capital gains, unrealized capital gains taxes. And, this is, one of the fallacies that, we go through from a lot of times, particularly in Washington, D.C., as they're coming up with ways to tax the rich, right? And we went through the whole analysis yesterday about how is it that these, CEOs that have these, multi-billion dollars of net worth, how they use they can't sell their stock, because if they start selling their stock, that depresses the stock value, because everybody says, oh my gosh, why are they selling their stock, right? So it's all about insider sales. And so what they do is they take their stock, go to the bank, and they borrow money against it. They get a tax-free, basically a tax-free sell of their stock by borrowing against their stock. So that's how they have their private planes and houses and all these type of things, and they still have all this stock. So, when they talk about Elon Musk, net worth, and they talk about his stock value, like he's worth $200 billion. Well, the problem is $200 billion less, how much did he borrow against that stock, right? That's what you don't know. But, the whole problem with this unrealized capital gains tax that Washington was touting, throwing around here earlier was, you own a stock that's up, 100%, but you haven't sold it. And right, and this was the argument, like all these rich people have all these stocks and they don't ever sell them, so they never pay taxes, so they need to pay a capital gains tax on that every year. Well, what Facebook and Meta stock showed us is the other side of that story, is that Meta's lost 73% of its value. So now Mark Zuckerberg has a huge write-off as a capital loss this year, unrealized capital loss in the value of his stock, to write off against the other income he has coming in. So now everybody's all upset now because these big billionaires are getting these massive write-offs because their stock value went down. So, it's always great to try to tax, we're only going to tax you if you have a gain, but you don't get the write-off if you have a loss, right? And you can't do that. You've got to have both sides of the ledger. And that's why these things are always ridiculous. And again, the people that throw these things out, you just kind of want to smack them upside the head and say, go back to school and learn how things work. But then, unfortunately, these are people that we are electing to go to Congress, unfortunately. And
a lot of these people, they're not actually paid. They don't have a salary. Many of them it's very small, considered in proportion to their wealth. So when you look at the big picture, they're getting paid in stock a lot of times.
Yeah. And we did that. Actually, Bill Clinton did that back in the late 90s when he put a cap on CEO salaries at $1 million. And Wall Street very effectively came out and said, that's fine.
Great.
We'll pay you out in stock, right? And that's why we now have surging stock buybacks, because who's the people that sell back stock? It's insiders. It's not retail investors selling stock back to the company. It's the insiders selling their stock that they've been granted back to the company and turning that into wealth.
Well, but not only that, they're also issuing bonds. So think about who this serves. This serves management. Mm-hmm. Because, look, many of them, there's a handful that have been around for a long time. But look at the tenure of most of these guys. They know the writings on the wall, especially middle to upper management. A handful of CEOs been there forever. But these guys, they know, look, hey, we'll issue debt, especially when interest rates at all-time lows.
Yep.
Turn around, go buy back bonds. Who does that benefit?
Buy back stock.
Shareholders.
Yep. No, it doesn't.
And
no, it doesn't benefit shareholders. And this is the big myth.
Well, long term though, right?
No, it doesn't.
No.
Okay, let me ask you a question. You own stock in anything?
Yeah.
Okay, what do you own? Pick a company you own stock in.
Apple.
You own a stock in Apple. Okay, great. So Apple says today I'm going to buy back $500 billion worth of stock, which is what they bought back so far, right? So they're over here, they're buying back stock. Did you sell your shares of Apple?
No.
Okay. So how did you benefit from the buyback of those shares?
Well, it's typically going to elevate the price as more,
That
demand.
That hasn't worked this year.
Well, not this year, but have they done as many buybacks this year?
Yeah, actually they have. We have a record number of stock buybacks issued this year. We have $1 trillion worth of buyback announcements this year. So,
well, I think you've had the announcements. I don't think you've had the number of buybacks that you historically have.
Well, no, but we're having more. They're coming in. Okay. So, but here's the point is that, see, any day of the week, this is the fallacy of stock buybacks.
Yeah.
Any day of the week, you can go out and sell your shares in the open market.
Okay.
You never sell your shares back to Apple. Apple doesn't ever call Danny Ratliff and say, Danny, we want to buy your shares back. Right?
Correct.
So the theory is that if the company's buying back stock, the price goes up, so that benefits you. But that's not a return of capital to shareholders, which is what that is termed as, right? Companies buying back shares, you're getting a return of capital from the company. You're not. And you can execute that trade every single day. Now, if the company issues a dividend,
that's a return of capital.
That's a return of capital. And yes, you get that as a shareholder.
Correct.
So the only people that benefit really, truly on the inside of stock buybacks, and this is why they were illegal until 1980, is because it's a form of stock market manipulation. And the SEC had outlawed these post the Depression because they manipulate the stock price. But the only people that now benefit from those really are the insiders of companies that are selling their shares back, because that's who the company actually buys the shares back from.
Correct, but you can benefit from it if it's going to prop the price up. You could turn around and liquidate, right?
But you're still not selling to the company.
It doesn't matter who you're selling to. I don't care who I sell to. If it's you, if it's Brent, if it's Okay,
but let me ask you a question. Let's say a company has no stock buybacks, and the market is rising. Is the stock price going to rise with the market?
It should.
Okay. So what was the benefit? Did Apple stock price rise this year because they were doing stock buybacks when everything else was falling? The answer is no.
Yeah.
The majority of the stock price appreciation follows the market, not stock buybacks. Right? The only thing that really stock buybacks, provide is a boost to earnings per share by reducing the number of shares outstanding, which theoretically helps them beat their earnings estimates, and the stock goes up, right?
Correct. So, but it is a form of manipulation, which historically.
There you go.
I was never arguing with that. At the end of the day, are the markets better or prices better because of stock buybacks?
Yeah, 40% more.
Yeah. So there you go. So you just made my point.
No, I'm not saying that stock buybacks don't lift prices, but it's not a return of capital to shareholders.
Yeah, but look, I don't care where it comes from. If it goes up, it goes up. I mean, that's what I'm getting at.
All right, but this was not the whole debate this morning.
I didn't need a dissertation on this.
No, I just wanted to get to the whole point about the windfall profits tax, which is another stupid idea.
Yeah,
that's coming out of Washington.
Well, I mean, we're talking about trying to make inflation better, right?
Yep.
But we're going to tax companies already that have been under pressure historically. And where were they during the pandemic when these guys weren't making any money, right?
Right. Where's their windfall profits loss, right?
Yeah.
Or windfall loss tax, right?
Yeah, there's none.
Tax rebate. Yeah, no, this is the whole problem, which is, again, short-sighted views. What's the problem? Why do we have high oil prices, right? The one of the reasons we have high oil prices is not really lack of production. We were a record net exporter of oil 2 years ago.
Yep.
So we have the potential to produce oil. So that's not really our problem. Our problem is refinery capacity, right? We are at maximum refinery capacity. So if we want cheaper gas prices, you need more refineries. That's what this really comes down to. Problem is if I'm going to invest money into a refinery, it takes 10 years to start getting a recoup on that investment because they're very expensive to build. And with an environment that's very hostile to energy companies, right? We all want to put you out of business because you're evil oil companies and you're polluting the climate. Why would I go invest that kind of capital to build a refinery? Plus the fact that I can't even build a refinery, somewhere like in California because of the environmental regulations. Why, that just can't get done. And so now you want me to come help. President Biden just recently said that, if oil companies don't start bringing down the price of gasoline, then, which they have no control over, by the way, then he's going to start, going after energy companies. So again, here's another attack on energy companies. So now let's tax them on their windfall profits, which is going to even further impede them to produce more oil, right? So, these are all these kind of backward ideas that come out of government that have the exact opposite effect of what you want the outcome to be. If you want oil companies to drill more, stop going after them and attacking them and say, look, we're going to open up leases, go drill. We need more oil. Please go drill. We'll give you tax credits if you'll go drill. We'll give you some write-offs if you'll go drill. Get that production back up. You make them temporary, whatever it is, but give them an incentive to go out and drill and then remove the long-term, attack on these companies and then allow them to go do their job. Because look, this isn't going to get better. As we talked about yesterday, the problem is that all this environmental, ESG and climate change, new energy, clean energy environment requires a lot of petroleum inputs to build them. The carbon footprint for an electric vehicle is about 3 times as large as a regular ICE vehicle. So it just requires a lot of plastic and petroleum and everything else to go in and build these cars and windmills and solar panels and all this type of stuff. So it's fine to go after these energy companies, but your long term, you're making things more expensive for everybody because you're restricting the growth in petroleum production, which is what you need. And it's not just about oil and gas. It's about everything that you use, eat, touch, transport, etc., that all involves petroleum in some shape, form, or manner. So, go ahead.
No.
I'm sure you want to throw something out there.
Not after this last one. No. Hey, and FYI, stock buybacks are down 22% for the year.
So far. But the window just opened back up, and you have $1 trillion of authorization by the end of the year. So
22% from third quarter.
$5 billion a day coming.
All right, let's see it.
We'll see. No. Look, it's not surprising stock buybacks are back down this year because markets are down, right?
Yeah, it makes sense now, right?
Companies are the worst. They're the same as individual investors. They buy at the top, and then they don't buy at the bottom. So
hopefully they're buying now.
We certainly need it. All right, quick break. We'll come back, wrap up the show with Danny Ratliff. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The end of the year is fast approaching. What will the new year bring? Join Richard Rosso, Danny Ratliff, and Lance Roberts for our year-end economic review special event, Tuesday, November 15th. How to address higher taxes in the new year. Should you delay your retirement in 2023? What will the midterm elections mean for markets? Register now at realinvestmentadvice.com for our year-end economic review special event with Ratliff, Rosso, and Roberts. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show this morning. Dividends. It's always kind of an interesting topic to talk about because it's not exactly what people think it is typically. As a good example, Devon Energy today reporting very good earnings and cutting their dividend from $1.65 to $1.55. Now, that's not surprising because Devon Energy pays a near 6% dividend yield. So they're well above the 4% treasury rate. So again, earnings, dividends should basically track your treasury yields to some degree. So again, you've got a real outsized dividend for Devon, but that cut is, not, so that cut's not surprising. But one of the things that people typically get trapped into is there's a lot of media commentary is that during, bear markets and those type of things, invest in dividend stocks. And, a lot of people will say, well, I own XYZ company for the dividend. I like the dividend, so I own the company, right? And that's, and particularly during the market rise, right? I own this company because of the dividend. That's a real common statement. The problem is that in a bear market, and particularly in a recession, which we're not in yet, dividends get cut because companies begin to rework their balance sheet, so to speak, in order to offset a slower economic environment. So if stock prices are falling and things are getting tough, the first thing they do is they come in and start cutting dividends. Now, just 3 years ago, we were talking about this in relation to oil companies because, oil prices were down and, revenues were declining and stock prices were down. And we saw a lot of oil companies cut their dividend because they were trying to, stabilize their stock prices and stabilize the revenue losses. Now today, record stock prices, dividends, and are all great. But at the time, a lot of people that were owning these stocks that were down, they were also down and losing their dividend. And this is one of the things that happens to a lot of people is like, I don't care if the stock price falls by 50% because I'm getting this great dividend.
Oh, but you do. That's the problem.
Right.
Because everybody says that. I mean, I can't tell you how many people we get calls a lot. And
yeah.
Hey, look, I need to build a dividend portfolio. I need companies that have never cut their dividend. Well, first of all, that's very few.
Right.
And second of all, and if it is, the dividend wasn't a whole lot to begin with.
Right.
Right. Can you live off that dividend is the number one question.
Right.
Can you physically live off that dividend, and can you wait for those assets to come back? Because that's the problem is that these articles are great. And I'm seeing them all over the place as well. Right. So I get it. I mean, it's on top of everybody's mind. Everybody's looking for the next best thing. And how can you invest, smart right now? And I think that's the problem is that I'm not sure you can in this environment and expect not to see a huge decline.
Right. Well, the stock price will go down.
Decline.
Right. Well, the stock price will go down with the market. Now, dividend stocks typically don't fall as much as non-dividend paying stocks, right? So from a relative perspective, right, I buy dividend stocks and they don't go down as much as the markets. The market goes down 50, you're down 35. Problem is that you're going to be wanting to sell your dividend stocks at that point anyway. But here's the other problem. So even if you hang in on this idea that I love this company and it's down 50% and I'm not going to sell it because I love this company and it pays a great dividend, the problem comes when they cut their dividend. And a lot of times during a recession, the average dividend is cut by almost 50%. And if that's average, that means a lot of them are getting cut out completely. And we've seen this in both previous, the dot-com crash, great financial crisis, those dividends get slashed or cut entirely, and they get cut and slashed when you're down 50%. So now you're down 50% in your portfolio and you lose all your dividends.
Well, and your income,
and that's
right?
the problem.
So
right.
that is the big problem. So now I can play devil's advocate on this as well. Look, we like dividend-paying stocks. We own dividend-paying stocks.
Yep.
We do feel like there's going to be a lot of upside in the future. And the companies that we own, we feel pretty confident about. However, the problem is that people take this, and they don't take it part and parcel. They take it and say, we're throwing everything in here, Lance.
Right. And then they go and then they go search for the highest dividend-yielding stocks and buy those stocks because they have the highest dividend yield. But companies with the highest dividend yield also represent the companies with the most risk of cut.
Well, not only that, but they're trying to entice you to invest. So sometimes they're not always the most sound companies either.
Well, that's what I mean. And right.
Yeah.
So why do companies? So a company pays. So ExxonMobil. I'm just picking this. Let's not even use a company. ABC company pays $1 in dividend, and the stock trades at $100 a share. Okay, make it easier. Stock trades at $10 a share. Pays $1 worth of dividend, and trades at $10 a share, right? So it's a 10% dividend yield, right? So I'm going to go buy that company. Stock falls to $5. The stock now has a $20 dividend, a 20% dividend, right? Because of the price decline. So when you're out going and buying stocks with high dividend yields, that's high dividend yield is a function of the falling stock price. So in a lot of cases, to Danny's point, we go out and we chase the stocks with the highest dividend yields. Like, wow, if I get this stock at this price, I'm getting all this dividend yield. The problem is a lot of times that's a reflection of falling stock prices. And one thing you want to look at if you're buying a dividend yielding stock like ExxonMobil or Devon or whatever, look at what they actually pay out in dollars per year, because you don't get yield. You don't get the dividend yield. You get the dollars that they pay out in cash every year in terms of the form of a dividend. So in other words, if I can buy, well, here, let's just take a real life example.
Well, in a good example, this would be probably the 2010s, and everybody was dumping everything into MLPs. So like, you remember like Sands Permian, and there was a handful of others that had these awesome dividends. And I would see people put their whole retirement, their whole portfolios into something like this, and then the stock would just nosedive, or these MLPs would, but they're stuck holding them.
Yep.
And so, and then even in that, I mean, we can get into, how do you hold those? Do you hold them in retirement funds or not? I mean, that's a whole other dilemma, but or debate here. But
Right.
what you're saying is absolutely right.
Right. No, I mean, that's what I'm saying. It's like, ExxonMobil pays $3.52 in dividend every. So if I own 100 shares of ExxonMobil, I get $3.52 for every share I own every year. Apple pays 92 cents on a dividend. So that's what I actually get, right? Now, the yields are important. What the yield tells you is what all the yield tells you is what the cash dividend payout is versus the current price. And so the one thing to look at is that when you go to buy things like, wow, this stock pays a 10% dividend yield. Sounds great. But if the price is falling 30, 40, 50% to get you that 10% dividend yield, that's the thing you want to pay attention to. Because if the stock price is under a lot of pressure, the risk is that they're going to cut the dividend. And that's what you need to be careful of. And that's the whole point of this conversation, is that just because you buy a high dividend yield doesn't mean you're going to keep that dividend yield when the company's in financial trouble and having to cut their dividends to stabilize their operation. So just be careful with that.
So I just for research purposes here, just went to a couple different financial websites. Every one of them on the front page has 20 best dividend stocks, 5 best dividend stocks, 10 best dividend stocks.
And then look, and to Danny, to your point, look, we own a lot of dividend yielding stocks in our portfolio.
You know the funny thing though?
Yep.
None of them are the same.
Yeah, no, of course not.
They're different on every one of them.
Yeah. Well, it depends on what you're screening for and what you're trying to do. But the point is look, we think, right, and as investors and as portfolio managers, we believe in buying companies that pay dividends because A, it increases the total return of the portfolio because you don't have just capital appreciation, but you also have the dividend income. So dividends are a very important part of the portfolio. So we're not saying that at all. We're not saying discount that. We're not saying you shouldn't buy dividend yielding stocks. You should.
We like them.
Exactly. But the things you need to be aware of is that A, their stock prices will fall with the rest of the market, just like with share buybacks. It doesn't matter. 80% of stocks are going to track the market up or down. That's just the way markets work today. The second thing is that in a recession, dividends get cut. So just be aware of those two factors, that just because you buy the stock and you love it and you love the dividend doesn't mean you're going to keep it. So as the stock price begins to fall and you say, you know what, I'm losing a lot of capital here, that's the more important question than I love the stock, I'm going to hold it because I like the dividend yield. Because again, if you lose the dividend yield on top of 50% loss of your portfolio, now you're in a really bad spot. And that happens a lot more often than you think. So.
Yeah, and this is where, we talk about diversification, and we're not big fans of modern portfolio theory in the sense that we need to be in large cap, mid cap, small cap, international, and, we're going to either overweight or underweight them. If we don't like something, we'll remove it altogether. But this is, I think, a good lesson in understanding that don't put all your eggs in one basket in that aspect, that, you can't just chase one thing and one thing only, because that's typically when you get burned. I mean, if you look at the portfolio now, we're holding cash, we're holding a lot of cash alternatives. We're still holding some fixed income. Not a lot, albeit, but still holding some. And the same for equities, which there's going to be a lot of opportunity. That's where, in our conversations that we have each morning in our investment committees, this is where I get excited because I'm really optimistic. We're going to find a lot of really good deals, and having the cash to be able to act on that, I think that's key.
Yeah, absolutely.
That's the problem I think most people encounter, though, especially when looking at stories like this. They take it all, they put it all there, and then when things do actually, if they get worse, you can't act on it.
Yeah.
You can't use it to your advantage.
No, that's right. So, any last minute thoughts here before we wrap up?
A lot of conversations about year-end planning. I think everybody needs to be mindful of, getting a pretty good idea of what your income taxes look like right now. We need to be looking at Roth conversions, need to start looking at planning for 2023 as far as what distribution planning looks like. Lots of talking to different CPAs of, what does the tax code look like? Does it remain the same? Or I think it's going to be really hinged on what happens next week with midterm elections. So we're having a lot of conversations around that. And so I think if you want to make sure that you're getting your ducks in a row, so to speak, start looking at what that income looks like, prepare for end of the year, look at tax loss harvesting. We're going to talk a lot about that on Friday as far as what tips you can do and things to make sure you're prepared going into 2023 so you go in on a good note.
There you go. All right, that wraps up the show for the day. Make sure and sign up for our economic review on November the 15th at noon. Again, so Zoom online meeting. Get signed up for that today. We're going to answer all your questions, talk about next year, what to expect, and more. That's November the 15th. Get by the website. Our latest blog post from Michael Leibowitz is out talking about yields and markets. We'll talk about with Mike tomorrow the FOMC decision today and what that means for stocks tomorrow. That's all coming up on the next editions of The Real Investment Show. Get by the website, realinvestmentadvice.com. Everything you need to know right there. Ask questions and comments as well. Happy to help you. realinvestmentadvice.com.